My next guest fears that housing prices have not bottomed yet and that it could be 2 more years before they turn around. Eugene Flood is president and CEO of Smith Breeden, which manages $8 billion, visiting us from North Carolina this morning. Thanks so much from a little bit further south. Yeah. Okay, Dr. Flood, thank you very much for being with us. And I do want to start on housing because we got these Case-Shiller numbers, and I know they lag a little bit. But they're still showing essentially that things are weak in the housing market. Getting a little bit better, but weak. And that is a scenario we're faced with for years, right?
That's right. At Smith Breeden, our forecast is that housing prices would fall from the peak to the trough using the FHFA numbers about 15%. So we are most of the way there. We are almost at the bottom. So that's kind of the good news. The more difficult news is that we're going to be here for a while. And so housing prices are going to bump around maybe a couple of months up, a couple of months down for about 2 years. The reason is that unoccupied homes for sale that are on the market right now.
Vacant homes.
Vacant homes. There's about 2.6 million of those by our estimate, and that's about 30% above the normal average. Those typically are the sellers that are the most aggressive.
Right, because they're paying mortgages on houses that they're not making any money on.
That's right, and so they've got to sell.
Okay.
We think that it takes about 2 years for the economy to work through that. So we're going to bump along the bottom here for about 24 months and then begin to have a gradual increase in prices.
Now, here's what I've been hearing from people like Mike McKee here, but also others, that even if the housing market bumps along for a little while, it doesn't matter as much anymore. The housing market's not that big of a factor in GDP anymore.
That's right. It has become a lot smaller. So we don't have to worry that it's going to be a big drag on the economy. However, it has always been and probably will continue to be for a while an important part of the consumer's balance sheet in terms of their assets. And so when that sector is in decent shape, not falling, but staying stable or increasing, that helps with the perception that wealth is in stable condition and then people are willing to spend.
So then if it's not housing that's going to, so housing is not the factor for a double-dip recession. What is it going to be? Jobs then?
What's going to push us into a double-dip recession?
Into a double-dip, exactly.
Well, if anything does, it could be a shock to the overall capital markets, so the stock market or the bond markets, that or another banking crisis could push us there. Or if jobs fail to accelerate here and actually decrease, then yes, we could go into a double-dip recession. But that's not our central call at Smith Breeden. We put about a 20% probability on that. We think that we're going to be in a slow growth mode, something like 2% real GDP growth.
Right, 20%, which, to some will focus on 20%, but really that means an 80% chance that we are not going to hit a double-dip recession. So, that's the positive side of that. Well, we are back with Eugene Flood. He's the president and CEO of Smith Breeden. And right before the break, of course, we were talking about this chance of a double dip, and I know your firm recently raised it to 20%. And related to that, though, about the economy is what the Fed is doing about it. Is it appropriate? Is their monetary policy appropriate for what is going on?
Yes, it is. Right now, what the Fed has announced is that they're looking at a different way of making interventions. Rather than announce a total amount, say $1 trillion or $2 trillion, and a starting and end date, they're saying, look, we're going to be in here for the duration. We're not going to lose this battle. And that's important because it will help to set expectations in the market that we're not going to become the next Japan in terms of having a decade of deflation. So they're saying we will make interventions for as long as we need to and at whatever amount we need to. So that's a good change in strategy.
That's stable? You think that makes a stable environment?
It makes for a more stable environment rather than presuming that they, number one, know the total amount that's needed and know the date by which things will be fixed. Now they're saying, look, we don't know the answer to that. Nobody does, but we're going to be here for the duration. And that's the right announcement.
We'll be there at the ready. Something else that affects central banks is the currency markets, obviously, or vice versa, you could even say. And we've been talking a lot about, the yen intervention. We've been talking about the Chinese yuan and whether it's overvalued or not. And I know that we've been, this intervention talk has even prompted the Brazilian finance minister to come out and say, look, we're in a currency war now, a full-fledged currency war, a race to the bottom. What do you make of that?
Well, I think the discussion has been too narrow because it's focused only on what economists would call the nominal exchange rate. So that if we look at, for example, the U.S. and Japan, the interventions that the Japanese government have been making. You look at the nominal yen, so it's at 84 or 85. That tells you part of the story. If you look at the last 20 years, the yen has appreciated by about 35%. But the other part of the story, which is very important here, is you have to look at what's happened to the costs in the U.S. versus costs in Japan to determine total competitiveness. Inflation in the U.S. over that period has totaled about 60%.
Okay, so that tells you what?
So that tells you that while the nominal yen has gone up 35%, Japan still has a 60% cost advantage that you have to subtract from that, leaving still 25% cost advantage relative to 1990. So,
okay.
So
the yen is actually. The yen is actually weaker than what we think it is.
In real terms, once you adjust for inflation, relative inflation, the yen has depreciated. So the loss of competitiveness doesn't have to do with just pricing. It has to do with the loss of attractiveness of their products.
But you've got to imagine that the BOJ, they must know that. Why did they intervene then?
Well, it's easy to focus on the nominal yen. Is it
and
85?
So their mistake is they're focusing on it too.
Well, over time, it's not the right policy. It's not a policy that is going to ultimately strengthen their economy because it's going to make exports, it's going to make the imports more expensive. That's going to be hard on their consumers, and it's going to be inflationary. So ultimately, it's not a stable policy for their government.
And what happens to us then? If every other currency in this world is trying to get to the bottom, what happens to us?
Well, we would hope that central banks will, from past experiences, know that this fight for getting to the bottom fastest is not one that helps the global economy. And so we would expect over time that central banks will back off of that and become more rational.
Okay, we would hope.
Yes.
And perhaps they may be watching this and thinking about that as well. Dr. Flood, thank you very much for joining us. Really appreciate it.